Mode.
Good evening, everyone, and welcome to Admiral Markets webinar of 20th of November 2014. Today, Chris will be with me, and we will talk about recognizing why critical thinking is vital to avoid overtrading. So we will take a look into some psychological stuff of trading, and we will take a look definitely telling you why you should never ever overtrade. And overtrading does not have anything to do with the market. It completely has to do with yourself, with you, and yourself only. So we will talk about it. Before we begin, our standard risk disclaimer. Online educational materials are developed by Admiral Markets as Estonia for a global audience. Therefore, please take into consideration that information in this session may not be suitable for everyone. To get a corresponding information on charting conditions and any other detail, please visit www.admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Risk disclosure statement stating all possible risks associated with Forex market. By accepting this risk, you are also proceeding further with us. Admiral Markets Week Ltd takes no responsibility for the information accuracy. The analysis represents the personal opinion of the author, me and Chris, and in no way it represents the actual suggestion for the trade. These are not MUK's opinions, and the website in the video is not .co.uk website, but the globalnews.com website. Forex is risky business, and this is a personal opinion only, and this webinar is for informational and educational purposes only. So we need first to understand what is undertrading, then overtrading. Then we will talk about assessing yourself and your psychology, and final part is critical thinking. So first, let's see basically what is undertrading, because there are two antonyms. We have undertrading and overtrading. Undertrading is giving up on a potential profit because you are not willing to enter a position. That is usually preceded by paralysis by analysis, and that has definitely to do with your psychological factors. First of all is fear of losing, because you are not ready to trade professionally, and you fear that basically you would lose your trade if you try to take a position. Fear of losing is the primary driver of undertrading. The second driver is not trusting the system or method. Basically, you have been trading a system and you try to trade a strategy, but still you are not trusting the system completely. That is because you don't have any experience with that system, and you simply do not believe that creators of the system made any money with it. Still, it has also many things to do, not just with you yourself. It has to do with understanding the market, understanding the waves of the market sound. So you will basically, just by looking at charts and learning those principles which me and Chris have been teaching you, definitely you will trust the system when you try to trade a system, because you know what you should do, you know what you should look after. And then if you stumble, that system is basically giving almost the same areas for entries, for take profits, for sellers, buyers, whatever, you will trust the system at least 80%. But that will be the first step towards normal trading, not undertrading, not overtrading, towards normal trading. But I know that many of you have been trying to find a winning system, but you need to know that there is no system which is 100% accurate, and you need to understand the market completely. Not trusting the system or method will definitely bring you the fear of losing, and that will definitely give you an undertrading perk. So you should never ever try not to trust the system if you already made money with that same system. Being afraid of market is also one trait which is common to under traders. Basically, those traders who do that under trading, They are basically afraid of the market, and they are not willing to take any risk, no matter whether the market is calm or volatile. They're simply afraid that the market will kill their account, or they are very insecure. So that insecureness, that fear, not having a trust, it will all lead to undertrading. The antonym to undertrading is overtrading, and overtrading means a trader is consistently making a couple of dollars above commissions, or is making random trades with untested methods. Overtrading is strongly connected to revenge trading, and by overtrading, the traders will definitely come into position when they will do revenge trading. Because if you make a couple of dollars just to cover the commission and to earn a little bit of money, basically it's just a matter of time when you will lose a trade. And then when you lose a trade, you will make revenge trades. So that will again be very, very, very bad for your account. It's the same basically as making random trades with untested methods, because revenge trading, you know, that hasn't anything to do with normal trading, with a proper way of trading. So you will be probably making random trades with untested methods while you're doing revenge trading at the same time. Greed will also come to the surface, and if you're greedy, then definitely you will be doing overtrading. So let's say earning 30 pips in a single day, it's not enough for you. You want to make 100 pips, and you want to go for that 100. So that is definitely a greed. Placing stops too close is also very, very dangerous, because if you place your stops too close, that can bring you very close to the death of 1,000 cuts. So placing stops too close will probably hit your stop loss very too often, and then again it will lead to revenge trading, and that will lead to overtrading. Also, very small pip count. Again, very small pip count is one of big mistakes, because if you do overtrades that same time when you do revenge trading, almost instantly when you have doubled up position just to cover your previous loss, you will close your trade, and that is definitely very small pip count. And again, you're behaving irrationally and you don't do proper trading. Some brokers prohibit overtrading. I was trading institutional accounts 3 years ago, 4 years ago, and I was trading it with a trader who basically did this. He waited for the price level to be touched, then he placed a big amount of money, because you don't have leverage when you're trading more than $100,000, euros, pounds, whatever. And when you place a trade, you just go for 1, 2, 3 pips and you close the trade if it's in profit. And that is basically a very small pip count. It will definitely give you overtrading, and brokers will prohibit overtrading when they spot it. You need to know that some brokers will do that, and that is the same when you're trading with big money. I would never suggest doing overtrading. Okay, and now everything which we talked about has to do basically with yourself. So you need to assess yourself. First of all, you need to ask yourself, and you need to decide what kind of trading you like to do. If you, let's say you like to watch every tick of the ticker and every change in the quotes, basically you want to be a scalper. If you don't like to I can say put your eyes on change of the quotes instantly, or change in the quotes during the 1 minute or 2 minute, you will definitely be an intraday trader, not a scalper. Again, if you like the high pace and you like to be highly involved in the market every second, then you are a scalper. If you don't like to, let's say, do research on intraday analysis, if you don't like to watch different pairs with bigger spreads, or you simply do not like the idea of trading while news is coming, then then you can be a scalper. But if you want to pay attention to major technical levels, also pairs which have big spreads, and focus maybe on 2 or 3 positions during the day, then you are definitely intraday trader. So you need to decide what kind of trading is for you. You also maybe like the idea of finding a medium. So you don't like to trade fast pace, slow pace, you want to be a medium. So you can be a scalper and intraday trader at the same time. Maybe you will take a part in the major part of the move and then exit as soon as it looks like the momentum is slow or shift. So that is basically in between of being a scalper and being an intraday trader. Also, I can say that many traders have different restrictions or circumstances that will force them into one style or another. So particularly you probably would change your styles each single time you notice that market is shifting. So you can change your, as you probably learned, I was doing the webinars, switching from scalp to scalp swing and scalp swing to intraday. And basically, unless you as a trader can get your cost per trade down to a very low level, then you basically want to put scalping on hold. So first, if you want to scalp, you need to cover for commission or for a spread and then to earn money. So probably all those steps which I'm mentioning now will lead you to become a medium pace trader. So you will shift from intraday to scalp, and that is perfectly fine. But then you also need to know, does it fit your lifestyle? Because you as a trader will have other commitments, other jobs, family. The amount of trades which are done should be in confluence with other lifestyle choices. You should decide whether you are able to do intraday trading, whether you are able to do scalping, whether you have the time for that. Will your family suffer for that or no? And definitely you need to take a look on your psychology inside yourself. Does it scare you? Does it scare you to trade? Does it scare you to make so many positions and to open so many positions during the day? Now, this is critical thinking, a simplified model of critical thinking, and this is the definition of critical thinking done in psychology. So a process by which we use our knowledge and intelligence to effectively arrive at the most reasonable and justifiable position on issues, and which endeavors to identify and overcome the numerous hindrances to rational thinking. That should be applied to your trading psychology. Okay? You use your own knowledge and intelligence to justify positions, to identify and overcome numerous obstacles which are hindrances to rational trading. That is basically the definition. And these are processes which happen in your mind while doing critical thinking thread. So the first step is reality, what really exists and happens outside the confines of our own mind. So you need to be real. You need to assess yourself. You need to be realistic with market. Is market giving you today, let's say, has it given you any chance to trade? For example, today we had a couple of potentially good trades, and then we exited, and then we saw that market is moving up and down. So we need to do a reality check. Do we really think that now, in this moment, we can do any particular trades? Yes or no? So you need to pose question to yourself, to your inner you. Be real, be realistic. What do you expect? But be realistic. Don't be emotional of today's market. Then, perception. How do you sense or experience reality at the first hand? So how do you feel that is this real, or maybe you're overreacting? Perception of that reality. If we firmly believe that now the market is really over and it will become slow, then we won't do any trades. And we really percept that way, first hand. We just do not want to trade anymore. even though we might spot a good setup, but we know we are real that market is very slow and we would basically skip any trades. Then, how we synthesize our perception of reality in order to create ideas and draw conclusions. Third step is drawing conclusions, guys. Now, our thinking process may or may not employ critical thinking. Conclusion is a result of previous processes. Result is that my conclusion is market is very slow. It gave me some positions today. I know that I might take one more position, maybe a New Zealand dollar, but I won't take it just because market is now at its very slow pace. So that is my conclusion. Now, thinking process which precedes the conclusion will have basically two paths. First path, or first path as American says, is basic emotional needs: security, acceptance, belonging, recognition, love. So definitely security for me, because I want to be secure. And values and principles are preconceived ideas of what is important versus not important. What is right versus wrong. Important for me is that I have made money, I am very secure, and I won't do any trades, although I might spot a good setup. So this is basic example of critical thinking process. You need to assess it in yourself. And I know that you usually are very excited when you want to trade, you want to take position, but you do when market is fast moving, when market is moving. You don't do that when market is not moving. Even though when market is fast moving, you should be definitely assessing yourself to see critically, does it justify your potential trade or not. And definitely if you lose and you want to make again a revenge trade, remember this webinar, remember these steps, and stop yourself. Do not do that. The first step is reality. Reality check. Always, guys, reality check. What really exists, it exists that you are basically want to do revenge trade. It's outside the confines of your own mind because it's real. Your revenge trade is not real. It will bring your account down. So you need to be real. Now, next steps for critical thinking, you need to adapt the mind of the critical thinker. Just because you're intelligent, or let's say you have a great knowledge in Forex trading, does not mean that you can think critically. It happens to every single trader. You need, let's say a genius may have the most irrational beliefs or the most unreasonable of opinions. Critical thinking is about how we use our intelligence, reality, and knowledge to reach objectives and rational viewpoints. Opinions and beliefs which are based on critical thinking definitely stand on firmer ground compared to those opinions which are formulated through less rational processes. So you need to have the mind of the critical thinker, okay? You need to be honest with yourself and yourself alone, okay? You need to be honest with yourself. Are you definitely accepting the truth and reality, or you're still living within confesses of your own mind? If you're open-minded and let's say skeptical at the same time, it means that you're seeking out the facts. You're seeking out information sources and reasoning behind your let's say potential trades, which you will judge later. You will examine those issues from as many sides as possible. And you need to be a free thinker. Free thinker means that you will think freely and you will restrain your desire to believe just because of social pressures. Translated to trading, you need also, you can follow anyone, me, Chris, whatever, but still you need to have your own mind. Don't follow the trades or trade setups blindly. You need to do that with free thinking. Basically, if you're agreeing with us, let's say for a setup, then great. If you see that that setup maybe is not so good, then you need to critically assess the setup and the overall process, and you should find out reasons why you think this setup is not particularly good. But free thinking is let's say, evaluation process. It's an evaluation process. Also, you need to have a natural curiosity to understand and be highly motivated to put the necessary work, let's say, in evaluating the multiple sides of trading parameters. So if I take this position, will I win? If I lose, how much I will lose? You need to have arguments for doing that. And you need, before any decision, you need to understand the decision before you basically think of making it. Now we have arguments. Arguments basically is equal to reasoning plus conclusion. Okay, reasoning plus conclusion. For example, I use the example, I don't like GBP New Zealand because it's too fast. Conclusion is, I don't like GBP New Zealand. I don't particularly like that pair, and that's the truth. Indicator is because, and it is too fast is reason. So argument is reason plus conclusion. So reason plus conclusion give you the argument. I don't like GBP New Zealand because it's too fast. Reason it's too fast. The conclusion is I don't like it, and indicator for that is because. It's because I just don't like it. It's too fast for me. I particularly don't like it because of the spread, but let's say that often it's very, very fast and it has big spread, and because of that I don't like it. Now we need to have warrant assumption. If an argument, let's say, has an warranted assumption, and this assumption is needed to validate, let's say, argument's conclusion, a critical thinker has good cause to question the validity of the entire argument. For me, that is pretty much warrant, so I don't need to question anything because I did that conclusion with reality checks. And I particularly don't like to trade GBP New Zealand. So you need to always have an argument for anything which you've been doing. Arguments for anything. Do you want to take the trade? If not, why not? What is reasoning behind that trade? Okay. What is the conclusion? After you made conclusion, you either make a trade or don't make a trade. You also need to evaluate information sources and arguments. Information sources are your sources of information, let's say, which you have been collecting over the internet. Most arguments, facts should support conclusions. But argument, you need to know, is only strong as its weakest link. Okay? So basically, if you think that my analysis is pretty much accurate and correct, you're doing evaluation of my information. I am your information source, and you're evaluating the information which I have provided you. After you evaluate information source, me, you will draw a conclusion which is based on argument. But still you need to be a free thinker to basically either accept or not accept the fact, whether you will take the trade which I present you on session recap or not. You also need to evaluate argument, and basically I also explained you. So after you make an argument, you need to evaluate it whether you will take a trade or not. Remember that assumptions are essentially reasons which are implied in an argument that are taken for, let's say, definitely to be true. Okay? So using, let's say, this previous argument, I don't like GBP New Zealand because it's too fast, the implied assumption is that basically GBP New Zealand is not to be traded. Okay? Now, critical thinking basically has a cure. You can cure yourself basically from potentially bad trades, for potentially overtrading. with these practical steps. First is everything which I've been talking about you need to be aware of. As I always say, the first thing you should do is do your reality check. So that is called perception of your mistakes. If you do a reality check and you go through all these steps I have been telling you to do, you will be percepting your mistakes. And maybe you won't be trading even though you see it a potential trade. Just because you are stopping yourself out from a trade, that means that you are still thinking very reasonably and you have reasons why not to trade. You should definitely avoid overconfidence. After a few wins, and there will be a couple of wins in a row, maybe 10 wins in a row, you will become overconfident. You will start taking trades immediately, feeling invincible. That means that you will forget all the rules. Don't forget it. So definitely avoid overconfidence. If you have a couple of losing trades, you're under pressure to make the money back. You will jump at any opportunity that will show the slightest possibility. Now, when the trade goes in your favor, you become more anxious, jumping at the next trade, closing it too early, and again, when trade goes against you, you're even more under pressure. Don't do that. Avoid that kind of pressure. Trading is not pressure job. You should be relaxed. I was doing, as I already told you, many times I was engaged with trading institutional accounts which some firms were asked for. And basically, if I feel the pressure that I need to make the money, and if I feel the pressure that why I didn't take the trade, why I, let's say, I maybe should, I remember that for every single trade I made, I needed to make an explanation. Why I did that, why, every time, why, even if I'm in profit, always why, if I lose, why did you lose, if I make profit, why did you take the trade? I felt pressured, and when I feel pressured, I cannot work and think rationally. Trading is not like any other job. I don't know which kind of job you have on your day trading, but I never would ever accept to do a job concerning, of course, trading, which will put a pressure on me. I can make everything in a deadline, but please do not pressure me. I will make trading, I will do the analysis, everything, but I want to avoid pressure, because pressure is not good. If you feel pressured, you will make many mistakes. You will definitely make many mistakes. You will become anxious, you will become angry, and you will be full of negative energy. Pressure maybe in other jobs, maybe, I don't know, in factory jobs, or I don't know, management jobs, marketing, pressure is good. But for trading job, pressure is not good. Remember that. Trading is not like every other job. Some jobs, the more you work, the more you earn. Trading is not like other jobs. The more you trade, maybe the more you will lose. So you don't trade, you don't overtrade. Okay, remember that. It's not like other jobs. Don't overtrade winners. Let's say that if you overtrade winners, you will become excessively attached to losing positions, hoping for a comeback. When you're in the red, you will get anxious and you will want to make up all of your losses at once. So you will be increasing size trading. That will definitely be overtrading and making revenge trading. You're afraid of missing out and jump in any trade. If it results in losses, you're even more eager to dive into the next trade. You know what I'm talking about. When you lose a trade, you're very eager to dive into the very next trade. Right? I'm right. Don't be impatient. If you're impatient, you will get impulsive and you enter into bad trades. You lose opportunities for good trades and you get the opportunities for bad trades. And it will become a danger cycle. Guys, clear your mind. Clear your mind. Remember what I'm saying. Clear your mind and don't be pressured. Let's say, for example, if you take a moment and think about your trades and think about everything which I was telling you today, you will have a clear mind. You will have much better results. Of course, having a trading plan and sticking to it, it's always, plans are roadmaps. You need to know where you're headed. Think about it. In order to stick to your plan, think about your plans, rules as giving your word. Do reality check. Assess all of your arguments, all of your conclusions, and basically give yourself a word. Treat yourself as you would treat your best friend, and keep your word to yourself. This is everything which I had for you today. Chris will take over. These are psychological webinars, and remember guys, trading is not just about trading system, trading methods, giving you free trades and whatever. We need to have these kind of webinars once in a while just to remind you how psychology of a trader is important. Now, thank you for listening to me. Yeah, thank you, Darshan, for comments. I will pass over the presentation to Chris. I will be with you soon, of course. And if you have any questions, of course, feel free to ask me.
Alrighty, thank you so much, Nenad, for that great part of this webinar. I'm going to switch over the screen here. There we go. Let me check if it's good visible. Looks good to me. Alrighty, so Nenad already mentioned a lot of great things in his part. So it's going to be a tough job for me to equal that. So why critical thinking is vital in avoiding overtrading, excuse me, is something, and Nenad, of course, mentioned how important it is, and many good tips, why we have to be critical, why we have to always think for ourselves and double check all these setups and thoughts and not get carried away by some internal elements, internal processes of thoughts, let me say it this way. I wanted to start out with the question, to trade or not to trade, a bit of philosophical starting perhaps. Yes, no, what do we do? The doubt in our mind is always a little bit there, isn't it? Especially if we start out trading, especially if we're maybe having some doubts about our confidence in trading. Often enough, the confidence comes at the lack of confidence comes at different points in one's trading career. Maybe not at the very beginning, actually, because the lack of experience, the lack of bad experiences, maybe the fact that you're just starting out and trying it for fun, maybe doesn't create actually too much lack of confidence. It's just more curiosity at the beginning. Then of course, as the experience and knowledge increases, some let's say questions arise, and some confidence might decrease, because what do we do what, when do we do what, and then you might think that you have the answer. You find some tool or indicator that helps your trading and you're improving your trading. That's great. But then you hit kind of the second wall where that thing that you were doing suddenly doesn't work anymore. It doesn't seem that simple all of a sudden. And yeah, sometimes you even have a third wall like that. You kind of like have these ups and downs where everything seems very rosy and perfect, then you just go through a big tunnel of difficulties, and you just don't see any answer or solution to it. Some traders unfortunately stop in that tunnel and don't make it to the other side. If you do, then unfortunately it's often not the only tunnel. So yeah, it's difficult to live through that. We have a lot of internal thoughts that that make that happen as well. So to trade or not to trade, it's always something that is popping up in our mind. And what our internal brain is telling us will often have an impact on what we do. If our brain is telling us, ooh, I like that trade a lot, I really like that trade a lot, ooh, I can't live without it, well, then we're going to take the trade, whatever trading plan we have. So you can see how important that critical thinking is towards effective implementation of our plan. So basically, there are all kind of things that could be leading to these thoughts and ideas. Self-doubt, a whole list of psychological things probably. Practical thing that could happen is just staring at the charts. When we just stare a lot, there's a lot of moments that basically we could have some problems or have some how do you say it, some, let's say, events on the chart that could lure us into thinking that that could be interesting. Oh, that pin bar just looks too good not to take. So the more we look at the charts, the more we kind of like create reasons, see things that are more like ghosts, that are not there, or that perhaps are there but are not really fitting in our trading plan, and we ignore that particular side of things. So, you know, there are a ton of reasons that could lead to losses. Staring at the charts in some cases is one of those. In any case, whatever the reason is, it could lead to more nervousness and basically to the fact that we're starting convincing ourselves of that evidence. It's like that the more we see the evidence, the more important that particular piece of evidence becomes. It's that all of a sudden that pin bar is not only a pin bar, but it's the super pin bar of all times. You know, it's like the best pin bar ever. The more you look at it, the more you really convince yourself that that pin bar just cannot lose. So the more we start to convince ourselves from that, or the more nervous we get from something, the more we cannot keep our calm and our nerves together, and we just have to make a decision. Either that decision is closing down the PC and walking away, which is actually the best one, but unfortunately, often enough, it is either entering too soon or too late. So we just can't keep it together there and make a emotional decision to take a trade by either, as I say, entering too soon, which is jumping the gun, or too late, which is kind of like chasing the trade. When we see a trade happening and it's actually past us, but you know, we're like, oh, we missed that setup, I wish I had it, and we still try to take it. Because we can't stand the thought of not actually having had that trade, despite the fact that our moment of taking the trade is already in the past. So what drives this behavior? In general, it's a confirmation bias, and it's not something that is only in Forex trading. It's actually something that is a common denominator of humans in general. Perhaps not for you. Maybe you've got rid of that confirmation bias. Maybe you never had it. But across the board, one of, let's say, a critical thinking error that is often encountered, at least according to a book I'm reading now, Critical Thinking. I forgot the name. It's a very popular bestseller book. Maybe you know it. Is the confirmation bias. Confirmation bias. So it's apparently something that is not only for Forex traders, it's across the board, and many people have it. So it's one of the critical thinking errors. And what we do basically is our brain tends to search for confirmations, and we look for evidence in favor of our analysis. So we just, let's say we have a certain setup, and we just pile up the evidence. Oh, there's another reason. Oh, that also looks good. Oh, something there. Wow, look at that. That looks just awesome. So we just look for more and more confirmation. So we get a bias. We get a kind of, as I wrote here, kind of camouflage or rosy glasses we have on. So it just looks perfect. It just can't go wrong. There's no way that this is not going to work out. Whatever we set up, that's the confirmation bias. Now, eventually we're going to lose that confirmation bias. That's either because the trade has gone for a loss, or the trade is going against us. Because if the trade goes well, then probably we are not able to see it. When either of those two happens, it goes seriously against us, or the trade ends indeed for a loss, then suddenly the reality hits us in a way. The rosy glasses have been removed, and we see the reality. We see what actually was in front of us all the time, but wasn't perceived in the right light, wasn't perceived correctly. We see what we should have seen, but too late. After the trade is taken, then we see bad things. We see filters. We see that we overemphasize perhaps some good things and didn't look critically at counter evidence. So confirmation clues basically is before the entry we see confirmation clues, reasons for taking the trade. After the entry we see reasons for not taking the trade. Then we all of a sudden see filtering evidence. So in a way we're like detectives and have already a bias before the case is opened. Which also happens, by the way, at least as far as I'm not a detective, nor do I know, well, I know one detective actually, but anyhow, what I've heard from series, in any case, is that, and the occasional article is that they tend to do have that as well, detectives, that they have a sort of preconceived idea and they look for clues to support that. But I don't want to offend any detectives in here, so if that's not true, apologies, but I think that's familiar to me. But anyhow, so anyhow, the opinions can trade can quickly change depending on how the trade develops, and that's something we want to avoid too, because those roller coasters up and down. Nenad has showed many times that graph, right, with the emotions, like euphoria, and then like, oh no, bad things, no, good, you know, these roller coasters we want to avoid. We're going to have some ups and downs like this, but we want to basically trade like this as much as we can, and there's going to be some ups and downs like that. I mean, who's not going to be happy if you win 3% on one trade? A bit happy, at least to a certain degree, but I mean, you want to, you know, or a bit annoyed if you lose 3%, right? But you want to keep it flat, the emotions, as much as we can. If you are getting too happy or too annoyed by whatever you win or lose, chances are you're actually risking too much. Then you might not want to win 2% or lose 2%, but go down to 0.5%. And if you feel no emotions with that, you're on the right track. That's the risk probably that does fit most likely fits your profile better. So anyhow, this is a dollar CAD daily chart, and you can see, of course, how a trade development, let's say a breakout to the upside, would have various responses as you're taking a trade. Let's say you take the trade early here, you live through pullback, then it goes your way, you live through pullback. You can see already the emotional roller coaster that could be connected to that trade. And you just price this emotional roller coaster. If you look at price, look how many ups and downs this has, and within these ups and downs it has ups and downs, and within these ups and downs it has ups and downs. It's just going up and down constantly, consistently, anytime, anywhere. And if we don't have the, let's say, the spunk to live through it, then we're going to be toast. There are going to be ups and downs always. So if we can't live through it, we might as well not even enter, because that's just the fact of life. The fact of trading is this. So many times we're not going to have a perfect trade with a perfect entry and exit. So the goal is to remove this bias, in my opinion, from trading. Nenad mentioned many good things already, and I wanted to emphasize the bias. Now everyone is going to have a bit of bias, so totally neutral trading is difficult, but we can remove it as much as we can, at least, and try to remove the opinion from entering our analysis. What we want to make sure is that we don't put our ego against the market, because putting our ego aside is extremely difficult once it's in the game, once it's in play. And often enough, many times our ego will lose, and if things really spiral out of control, we might want to take revenge, because in name of our ego, and it could only get worse perhaps. So it could be very nasty and ugly. Now, what do I mean with not placing our ego against the market? What you might wonder, like, what does that mean? Well, if you have a certain trade and you're putting an emotional stake in it, like, okay, I really think, let's say you're saying, I really think the euro dollar must go to 120. There's no other way. And the euro dollar doesn't do that. And you risk 5%. Well, it's going to hurt. You're going to be annoyed because you really had a strong opinion on it. you know, the euro dollar is stupid if it didn't do that. Once you can put a trade, place a trade, and the currency is stupid, if it doesn't do that, you know that you're putting ego in place. And you have a bias. You're having opinion, a strong opinion about a particular trade. That's when the moment has happened. In my opinion, this is not good. Now, some of you might think it's good because you need, perhaps the counter argument is that you need a strong opinion to stay in a trade, because if you don't have a strong opinion, you're going to not be able to live through those up and downs. That's fine in a way. I would agree with you, but as long as it doesn't lead to revenge trading, as long as it doesn't lead to over-risking, as long as it leads to a consistent process that each time you handle that the same, and you're just playing your edge, and you're just using that bit of confidence, extra boost of confidence, to make sure you're staying in the trade and following your plan. That's okay, right? That's fine, as long as it's consistent and doesn't lead to any exaggerations. In most cases, it's too exaggerated and leads to mistakes. That's the bad side. So point 2 is that we want to trade as, let's say, neutral as possible. I want to keep focused on facts. Now, what does that mean? Basically, focus on the roadmap, focus on the trading plan, and focus on a step-by-step approach. Now, you've heard me talk about this more often, so I don't want to bore you too much with these things, but using an entry model by checking off things like the Tafta model, looking at the trend, opportunities, filters, trend, opportunities, filters, trigger, and the entry, and then the management, right? Trade management and the risk and psychology management. Those are the 3 pillars, in my opinion. The entry and exit, basically, and then the risk and the psychology management. So once you implement this trading plan and focus on implementing it step by step, then we're taking the emotions out of the game. Now, within trading, that's the plan. That's the organizational plan. Now, within trading, you know, when you're making your actual entry and exit plan, how can we remove the emotions from that? In my opinion, it's about removing the need or the act of predicting, but using the science or art of reacting. So forget about the stuff like, oh, euro dollar is going to be, I mean, it's fun between you and me to make an assumption like, oh, the dollar is going to be down at 119 by the end of the year. That's all fine for fun. But it really doesn't matter if it's 119 or 120 at the end of the year, as long as we're in the short and we shorted it above the price, whatever it ended at the end of the year or before that. It really doesn't matter, right? So it's not so important about prediction. It's about reacting. We could think or have the opinion that the euro dollar should be, must be, ought to be at 120 by now. Who cares? As long as we react in a profitable manner. So what we want to position ourselves is in a way that we let the market decide. Whatever the market does is great, is grand. Market is king or queen. Market is perfect. And we let the market decide whatever it wants to do. We set up decision moments. We set up lines in the sand. All right? We say, okay, if the euro dollar gets down to this trend line or up to this trend line, then it's at a decision spot. Those are the lines in the sand. If it breaks one of those 2 lines, then it's a breakout. And when it shows the lack of a false break, I will take by showing a strong 4-hour candle that is closing near the low and it's fully underneath the trend line, I'm taking a short or long, or only the short. So we have a point on the chart that price needs to go to and then do something, and then we will do something. Or perhaps we won't do anything, but we will say we'll be interested, and then if it does that and that, then we'll do it. You can make it as long as you want. Of course, if you make it too long, then it becomes a bit impractical, and you might never trade because it's too complicated. But you know what I mean. If it has to be within reason. But within reason, you're letting the market decide. You're neutral. You're like the wind. price is here and you're waiting for price to get here or here. And as long as it stays here, you're doing nothing. You're neutral. And if it then gets there to the red zone, then you're interested in shorts. As you know, at the moment that, for instance, there's a pin bar or some other candlestick, bearish candlestick pattern, you're interested. That would be, let's say, the confirmation. So that's when you want to trade it. So often enough, when you're in the trading room with me, maybe some of you join me occasionally, then you will hear me say often enough zones where I'm interested in and what kind of action I'm looking to see before trading it. Those are kind of my lines in the sand. Those are my decision spots. And I let the market then make, I have the plan, I know what I'm looking for, but then it's up to the market to either show that to me or not. And sometimes it could take a while before that happens. So here I'm reacting to whatever the market is doing. And if the market does what I want to see and I implement what I wanted to implement and it still goes wrong, what can I do? It's the market, for whatever reason, did what I wanted to do but didn't follow through. So yeah, that can happen. But I didn't trade impulsively. I didn't trade emotionally. I didn't just jump in or chase the trade. I followed the plan, and I can't blame myself for that. I can look at the plan if the plan makes sense, if it happens too often, right? But you have to be careful of that because any plan can have streaks. So you want to make sure that you're not just exiting at a streak, at the end of a streak. Right? So objective measuring points, basically. That's my main point here, in a way. So make objective measuring points. Focus on the correct implementation of that plan and not predicting the price. My main message here is the market is the market. It really is not out to get you like specifically. So try not to take it personally. I mean, it really, even if you think it's out to get you personally, then it doesn't really make sense to get mad about it. Let me say it this way. It makes no sense to worry about it. It's just there. It's just an object. It's like getting mad at a, picture yourself in a park and you're getting mad at a leaf. You're totally just shouting at it, and you see all those people walking by, and you're looking at you. Picture that when you get mad at the market, because it doesn't make sense. I'm just trying to help you, get some image in your mind that might help you get rid of that if you want to. Price chooses the path of least resistance. So, next point, it's all about finding decent probabilities that give you a long-term edge, and that edge is often enough small and not mega big. It's all about just a decent win percentage and a reward to risk. So that is difficult enough. So that was my summary I wanted to make about removing the bias. Any loss or profit, as I said, should not have any emotional impact. We should expect streaks. In fact, streaks should be directly related to what kind of profit we want to make. If we're aiming to make, let's give an example. Let's say we're aiming to make 5% a month. So at the end of the year, we want to make 60% in total. Then we should expect a streak. What kind of streak? Well, a pretty big streak, because if you're aiming to make 60 in a year, some say you might even want to expect whatever you target, that's the streak you should expect. So you should expect a losing streak of 60%. That might be a bit high. Others could say, okay, expect half of it. So it's still a 30% drawdown. So let's say be careful what you wish for. If you don't think you can live through a 30% drawdown, then think about the drawdown you can live through. Perhaps it's 10%. Then you shouldn't be aiming for 60%. If you can live through a 10% drawdown, maybe you should aim for 20 a year instead. So a setup is basically an entry and exit with an edge, nothing more. Setups can always go for a loss. Nothing is perfect. Always think critical about a setup. Always think about what if. Always think about a few filters, but not too many. Otherwise, we'll filter everything out. And try to have the patience to wait for high probability zones. And then take that trade and don't avoid it. Don't get paralysis of analysis. So that's my advice for finding a balance when trading. Nothing is perfect. Always think critical. Think about what if. Wait for the probability zones. Take that trade. Don't hesitate too long, or not, preferably, not at all, but okay. And expect the unexpected. Everything can always occur with any trade. All right. I'm not sure. I said let's take a look at the live chart. I'm not sure exactly why actually anymore. I had that in mind when I thought of this slide, but okay, we can do that. Any questions that you might have for Nenad or myself? This is the pound yen, and you can see how difficult sometimes it is to trade it. I mean, sometimes it has great moves, but it's got some wacky ups and downs before this upside as well. Before that, there was a great upside too. Look at this zone, a lot of choppiness there. It's easy to revenge trade, so be careful of that. Let's see, Lau has a comment. You're very happy. I mean, you're welcome. Very happy to hear that that psychology webinars are helping. Yeah, discipline, patience. It's oh so important, isn't it? Absolutely important. There's a world championship in chess, by the way, going on. I don't know if anyone is following it. And I like to compare it because of probabilities and psychology, mental game. There's no money management involved or risk management. That's, I guess, what we can see in poker, for instance. If you're really a good poker player, you can use the edge, of course, on a long-term consistent basis for your winnings. Of course, poker does have money management, risk management as well, so that kind of has some connection as well. So, it's interesting to see the parallels with poker and chess at certain points, like statistics and probabilities and mental game. And maybe even golf. I know that sounds funny, but in a way that we have to be very consistent, right? Each hit in golf has to, you have to have that focus for that perfect swing at that specific time. And training too, right? We have to have that focus as well for each and every decision in a way. Maybe slight overlap there too. So. Lau also says less is more. Yeah, it's easy to complicate things as well, indeed. Gotta keep that balance. Agree. Definitely. Well, let me show you the webinar schedule for next week. On Monday, we got the live trading lab, trendline trading. On Tuesday, Wednesday, we have Tuesday evening, by the way. Oh, what important thing. We don't have next week, Thursday, our session with Nenad, but it's actually on Tuesday instead. Tuesday, 6 p.m. Central European time. Now, Wednesday, Forex strategy, and Wednesday evening, we have expert opinion with Nenad. And then there's the premium webinar on the 29th, which is probably Sunday. No, it's a Saturday. Okay. So next week, Thursday, no webinar. It's on Tuesday instead. Well, thank you so much for joining us today. I always appreciate it. Wish you happy hunting and very good trading. See you all very soon. Cheers.
Cheers, guys, and trade safe.